you're going to learn a precise EMA setup and a clear trading strategy that is designed to help you trade in a more structured way. Make sure you follow the steps carefully, and let's get started. First, open your chart and add 5 exponential moving averages with the following settings. Click on Indicators and search for Ribbon. Choose the moving average ribbon indicator. This indicator automatically gives you 4 moving averages, and later you will add a 5th EMA separately. Now go to the settings of the ribbon and change the type of moving averages to EMA, since the goal here is to work with exponential moving averages. For the first EMA, set the length to 5. For the second EMA, also set the length to 5. Then, for the first EMA, set the source of calculation to high, and for the second EMA, set the source to low. You now have 2 EMAs with a length of 5, one based on the high and the other on the low. Next, for the third EMA, set the length to 100, and for the fourth EMA, also set the length to 100. For the third EMA, set the source to high, and for the fourth EMA, set the source to low. This creates a wider band above and below price that you can use to identify pullback zones. Now adjust the colors for better visual tracking. For both EMAs with length 5, set the color to white. For both EMAs with length 100, set the color to green. Then go to the Style tab and increase the thickness of the lines so they are clearly visible on the price chart. At this point, the 4 EMAs of the ribbon are fully set. Next, add the 5th EMA. Again, click on Indicators and search for EMA. Choose the Moving Average Exponential option and add it to the chart. Open the settings for this EMA and in the Inputs tab, set the length to 200. Then go to the Style tab, change the color to orange, and increase the thickness so this line stands out clearly on the price chart. Now the setup is complete. You have a white channel made of 2 EMAs with length 5, high and low, a green channel made of 2 EMAs with length 100, high and low, and a single orange EMA with length 200. These will be used together to find buy and sell signals in a structured way. Here is how the strategy works. First, this is a reversal-oriented trading approach. The goal is to identify the early stages of a new trend using these EMAs as filters. The orange EMA with length 200 will be used primarily for trend identification. When price is above the orange EMA, the market is considered to be in an uptrend. When price is below the orange EMA, the market is considered to be in a downtrend. A crossover of price above or below the orange EMA can be an early sign that a new trend may be forming. However, you do not enter a trade immediately after this crossover because relying on a single signal is still too risky. You need additional confirmation before taking a position. That is where the white and green channels come in. In the second step, you wait for the white channel to move completely above or below the orange EMA. For example, if price drops below the orange EMA, and later the white channel also shifts fully below the orange EMA, this confirms that the short-term momentum has aligned with the longer-term direction. The white channel, finishing below the orange EMA, adds confirmation that a downtrend is more likely forming. In the third step, you shift focus to price action and the green channel. Specifically, you look for a pullback of price toward the green channel. The idea is that in a trend, price often retraces to a midterm support or resistance zone before continuing in the original direction. You wait for at least a touch of the green channel by the price. This helps you avoid entering on a very shallow retracement and instead wait for a clearer, deeper pullback. Once price has pulled back to the green channel, the next step is to determine when the pullback is likely ending. For this, you watch the candles and the white channel. In a short side setup, you look for a candle that closes below the white channel. When that happens, it suggests the pullback has probably finished and downside momentum is resuming. This candle closing below the white channel is the confirmation signal for a short entry. You can then place a short position at this point with a stop loss placed above the green channel and a profit target set at a risk to reward ratio of 2-to-1. Now let's see how this works on the long side. For a long position setup, you start in the same way, looking at the orange EMA. You want price to cross above the orange EMA. This is a signal that an uptrend may be forming. Again, you do not enter a trade just based on this signal alone. You wait for confirmation. Next, you check the white channel. You want the white channel to also move completely above the orange EMA. Once the two EMAs with length 5 are both above the orange EMA, this confirms that shorter-term momentum is now aligned with a potential uptrend. At this point, you again look for a pullback of price toward the green channel. You want at least a touch of the green channel by the price. If the pullback is too shallow and does not touch the green channel, you skip that opportunity and wait for a deeper retracement that strictly follows the rules. Once price is pulled back to and touched the green channel, you wait for the signal that the pullback is ending. In a long side setup, you look for a candle that closes above the white channel. When such a candle appears, it indicates that upside momentum has returned and the pullback has likely ended. This is the confirmation signal for a long entry. You can then enter a long position at this point with a stop loss placed below the green channel and a profit target set at a risk to reward ratio of 2-to-1. You can also see similar patterns repeat later in the chart. After a strong uptrend, price reverses below the orange EMA. The white channel then moves below the orange EMA as well. Price pulls back to the green channel and a candle closes below the white channel. This confirms another short setup. Again, you place a short entry with a stop above the green channel and a 2-to-1 target. Following the subsequent downtrend, price eventually crosses back above the orange EMA. The white channel also moves fully above the orange EMA. Price then pulls back to the green channel and a candle closes above the white channel. This confirms a long signal where you can enter a long position with a stop below the green channel and a 2-to-1 target. It is important to remember that this strategy does not guarantee 100% winning trades. No trading strategy can do that. The goal is to tilt the odds in your favor by using clear, repeatable rules and disciplined risk management. Managing risk properly is essential to consistent profitability. Many professional traders recommend risking only a small percentage of your account per trade, such as around 1% of your capital, to help protect your account from large drawdowns. In summary, this EMA-based strategy uses a 200-period orange EMA for trend identification, a green channel made of two 100-period EMAs to mark the pullback zone, and a white channel made of two 5-period EMAs to time entries. The rules are straightforward. Confirm the trend direction, wait for the white channel to align with the trend, wait for a pullback to the green channel, and then enter when a candle closes beyond the white channel in the direction of the trend. By sticking to these rules and applying proper risk management, the strategy can be used to trade in a structured, repeatable way.